think you should take 10 to 20% of your portfolio and invest it into one of these multifamily syndication deals. Find the solid ones because you'll get cash flow from it. It'll go into your retirement account. You can do that if you're an accredited investor. If you're not accredited, then you would have to find, and I had to do a little bit more research on, if you can do a 506B into your IRA.
This is the Multifamily Journey Podcast, show 32.
You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
Hey, what's up, everybody? Welcome back to the Multifamily Journey Podcast. I'm the host, Blake Dailey, and just honored and excited to bring another good show to you today. It's kind of like the wild, wild west in real estate right now. People are just slinging out offers. It's been like Mexican standoffs with buyers and sellers putting in multiple offers and escalation clauses and kick out clauses and everything else. I know it's people with a lot more experience than me, a lot more doors and units and years are all seeing the same thing, all the way down to people who are just trying to get in, and even home buyers. So everybody is having trouble getting good deals right now. And some things I've been trying to do to overcome that is doing more direct to seller off market and marketing things, thinking back to my wholesale deals, trying to source these off market deals by going direct to seller. And what I've been doing is pulling more niche lists and really trying to find motivation and people likely to sell. So not only going, scrubbing for zip codes and property criteria, but also owner criteria, and really trying to get down to what I think is the best lead. So smaller lists, but hopefully more motivated people when I talk to them. So sent out a list of 200 mailers this past week. So hopefully this week the phone starts ringing, and then did some cold calling last week too. Just picked up the phone, got a couple leads there. But right now it's just hard finding good leads, and people are, especially multifamily owners, they're cash flowing right now. They really don't have any motivation. They're seeing the appreciation. They know the market's hot too, right? They're business people, and they're like, hey, why would I sell for this price? they're giving inflated prices. So that's happening everywhere. So if that's you, don't be frustrated. Don't be discouraged. Just look what you can do to set yourself apart. Maybe making strong offers, thinking about cash offers, or just thinking about finding better leads. It's all about filling the top of your funnel, getting in leads, because the more you can find, the more you can analyze, the more you can offer on, and ultimately the more you can close on. So think about finding more leads and then setting yourself apart when you do find those. And hopefully that works out. And then what's going on the other side of the coin with deals I already have, the 8 unit is going along. It's been a exciting and fun and frustrating process all at the same time. So you can go check out the progress of that over on my YouTube channel. It's just Blake Dailey on YouTube. And see the progress there. It's pretty cool to see where this thing started from, ripping it apart, and now new stuff's starting to go in. Going to float the floor this week because it's all uneven and unlevel, and they use like cement to lay the tile, so it's just crazy. And the electrical's all done, plumbing's about halfway done. So pretty soon here we're going to start to add in the drywall and the finishings and everything else that's going to make it look like a welcoming place for Airbnb guests to stay. So that project is a Burr and B, or it's a Burr project, and I'm going to rent it as 8 Airbnb rental units because it's close to a vacation destination in Fort Walton Beach. It's a really good location. So excited about that one. And on today's show, we got a good guest as well. So John Paniagua, he has an engineering background and works on Wall Street. So you're going to see this cool contrast between somebody that lives and works and breathes Wall Street, and that also invests in multifamily. What drives him to do that? Why, he's not the inside guy making all the Wall Street bets, but actually is pulling his money out and advocates having a balance, right? Don't be all one or the other, but has a really good perspective of that. So I think that'll be a good topic in this show. And John started out in single family rentals and then found out that just wasn't scalable. Got into multifamily as an LP in some syndication deals, and then as a GP. So now he's in over 300 units as an LP and GP split. And now he's starting a fund too, to be able to continue to offer these real estate deals. So a lot of good stuff in this episode. So hopefully you guys like that. And yeah, with that, let's get into the show. John, welcome to the Multifamily Journey Podcast. It's good to have you.
Thank you, Blake. It's a pleasure to be here.
Yeah, this is good. So I think you're my first stock exchange guy on the show. So this will be fun. We can compare the stock market with the multifamily a little bit.
Right.
But before we get into all that, how'd you get started in real estate?
It really started about, back in, it's a long story. Back in 1993, I purchased a house here in Bayville, Long Island. And I intended it to be a retirement home. I was thinking way ahead because I love the area, Bayville and North Shore of Long Island is beautiful. And what I ended up doing was renting it out. And then after 24 years, I decided it was time for me to sell it. I said, that's not going to be my retirement home. Mm-hmm. So what I did was I ended up flipping it. I formed a joint venture with two other partners, and I essentially flipped it. And I made a pretty nice, tidy return on it. However, what I wanted to do next was see if I could replicate it. And what I discovered was the operations that you would need to be able to do this quickly and to scale up was just, it was a lot of work. So I started realizing, say, okay, there's got to be an easier way, alternative method. And then what happened was in 2017, I was in Las Vegas at it was a financial insurance conference. They happened to have as a guest Grant Cardone. I never heard of him. I didn't at that time.
Yeah. What a way to be introduced into multifamily investing.
It was interesting. Yeah, because it was interesting because he didn't talk about multifamily. What he talked about was, going big, thinking big,
Yeah.
So I found it inspirational.
Yeah.
So
what
he did was
like the mindset stuff behind it.
Yes. Yeah, definitely. And I believe what he says, massive action, because that's what I'm doing now is massive action. So what I did was that evening in a hotel, I decided to look him up. And I saw there was an article of him, I think it was either Forbes or Business Insider. And he had at that time 4,000 units accumulated. But what was great about the article was he actually did a step-by-step. And he talked about the numbers, about why multifamily. I think he purchased a 48 unit, was his first one after the credit crisis. And he ran through the numbers and the light bulb went off in my head. I said, this is it. Mm-hmm. This is what I got to do. So I spent 2017 and 2018 looking at multifamily here in the tri-state area, New Jersey, in New York City, of course. And then I even looked in Connecticut, and I found that I don't know how to make the numbers work for investors. I was looking to do value adds and give them, 15% IRR or higher, 8% pref, and there was just no way with it was just prohibitive, and at least in my mind, quickly, because I usually use some quick rule of thumb scale, like a monthly rent divided by the unit cost. The unit cost here in New York,
price to rent ratio.
Yeah, so like $500,000 a unit. So that means I would have to charge $5,000 a month, right? Rent. I'm like, even New York hasn't hit that yet.
Yeah, that's good. So you saw in your local area that it was cost prohibitive to get into a good investment. So when you noticed that and realized that, where did you look to go elsewhere?
What happened was I then I realized and did a little research, and I said, I needed to get a mentor. Mm-hmm. And the first mentor I got was Phil Capron. I hooked up with him through Michael Blank's program. And that's how, when I met Phil, that was the first piece of the puzzle. And then Phil was a great mentor. And like I said, I ended up doing some joint venture deals with him and a couple of other syndicators, aspiring syndicators like I am. And they're great guys. And we ended up doing joint ventures on several deals. So the GP team is, on average about 5 to 7, on the team. And what we did was we formed a team so that each individual's skills were complementary, not supplementary, complementary. And it's really paid off because it allowed us to leverage each other's skills in terms of running, operating the property. And that's very, very important. Asset management, dealing with the property manager, dealing with the bank lenders, dealing with the investors. So that's how I ended up. I ended up, being a par GP LP on 3 deals last year, each, 100 units more.
That's awesome. That's awesome. And I love how it started out. You were taking action by yourself. You had partners in the single family game, stumbled into that first flip. And then as you looked into it more, it's like, you know what, this whole single family thing is not the most efficient route. And then it sounds like years later came back to it after this conference and really went hard on the multifamily stuff. So why don't we dig in right there? Like, how did you get into that first multifamily deal? How'd you structure that joint venture and everything that went in to getting your start in multifamily?
Well, that one, it was a deal in Southeastern Virginia. And it was funny because at that time, like Phil was my mentor. And then like he had me, as my mentor, he would teach me, how to do the underwriting, because I'm pretty good with numbers since I'm, working at the Wall Street. So doing the underwriting, looking, how do you look for properties without, and I didn't have an established any relationship with brokers yet or with property managers, just strictly from an underwriting basis, looking up deals, looking up, LoopNet, CoStar, you could, just doing a lot of the research online. Mm-hmm. And a lot of the deals that you get on, on these types of websites, once they get there, I know, everybody else has vetted them. That's why they're on market. Not
you hear all the time, like LoopNet is where deals go to die.
Yes. Yeah. Yes. It was interesting. And it was funny because I happened to see this one deal and I looked at it and said, and I remember talking to Phil and said, Phil, I think we should, look at this one. He says, don't. He says, I already got it. So even though it was on market, it wasn't. Already, Phil had gotten it. And what happened was we, as my mentor, he saw value in me and he said, let's do a joint venture, with other individuals. It was a great idea. And he's, like I said, he's been a great mentor. I learned so much from him. At that time, I also realized, I said I needed to, because I'm in New York, I says I could do more of these. And what happened was a couple of other joint ventures occurred and they brought me on, as part of the team. And it was really, really, really interesting, very exciting, with these other markets. But I realized that being in New York, and I'm going to stay still in New York, I needed to raise capital and I needed to build a system.
Yeah, which is good too, because you probably, bump shoulders, rub elbows with a lot of high net worth people there on Wall Street and working in the New York Stock Exchange. So that's probably like perfect for you in your current position. Have you found that's true to be able to raise just by being around those kind of people, that it has helped you bring capital?
Actually, no.
Really? That's the opposite.
Yeah. It's different because this is where Hunter Thompson, came in, because then, as my mentor on the LP side, because it takes more than just, rubbing elbows. You need to build credibility. You need to have a record. You need to definitely, it's interesting. I come across all types of investors, sophisticated investors that need education, investors that get it right away versus investors that would like to believe they have control of their money and they don't want to give it to a third party and let them, like the operators, let them run with it. Yeah. I found that. So I came across all types. And I got to
think though, like just like in a radius of like 3 offices or 4 offices, whatever, 4 blocks, you probably got to have more accredited investors than anybody that's listened to this podcast or been on it or, than most people. Right.
Exactly. And there's a bunch. All right. And they are looking outside New York. And I know money's leaving New York because you can already see down like in those areas, Southeast Virginia, in Georgia, obviously Florida, Texas, but now you're seeing Huntsville, Alabama, other areas there, North Carolina, South Carolina. You're seeing money flowing there because the value of deals are going up. Money is bidding price. It's kind of almost like a single family housing now. It's like, you make money from single family housing through appreciation, not so much like multifamily, which is forced appreciation through rents, increasing the NOI and adding value to the property. It's approaching now. Now you're getting both. Now you're getting money coming in to buy these deals, but they're increasing the price. And what happens is when your unit costs go up and the rents can't keep up yet, now
it's just compressing cap rates and deals are getting slimmer. And, that's where I see like the inexperienced operator probably being a greater risk right now because there's not meat on the bones. Like in the for the last decade, people have just benefited from the market going up, and it didn't matter if they didn't operate that well because the market was going up. So it's just, the rising tide lifts all boats. So they just benefited.
Correct. But what you're seeing now is that the Northeast money's leaving like the Northeast areas that had a lot of money that, everyone thought was the safe investment.
Has that benefited you though? Because you're investing outside of, you're in New York investing outside of New York. So when you're talking to these people, like, are you networking with these, high net worth people that are managing portfolios and managing hedge funds, whatever it is, whatever they're managing there in Wall Street? Are they looking to get into, Southeastern real estate where you're in, or are they looking just for completely different opportunities? Like, is it harder to raise from those kind of people? I guess those more high net worth people. Yeah.
The high net worth, the bigger players, you need credibility. You need to be able to show, that you can deliver. That's the thing. That's what I need to focus on, to be able to show them, to say, hey, there are opportunities out here. I know the sponsors. That's why I want to build out a sponsor network. So essentially what I want to do is create a platform, and I'm working with a couple of companies to do this, and to build a sponsor network and also an investor network. So when I build this funds of funds, I could talk to the sponsors and ask them, do you have any good deals? Do you have any, anything really good on the horizon that could meet these, the fund criteria?
Yeah.
And I'm looking for, the goal, the value adds, Class C and Class B, even going up to Class B.
Yeah.
Right now, because
and to be clear too, for the listeners, that fund of funds that John's talking about is something we've talked about on the show before. I think we first introduced it with Ashton Leverick in show 20 something. But that model, basically, John, and correct me if I'm wrong, basically what you're doing in a fund of funds is raising money into a fund and then investing that fund
in properties,
sponsors, real estate deals. And by doing that, you can pick the best sponsors, pick the best deals. You have the money, you just invest in the deal. And, there's different ways to do it. You can make money as the fund manager within that fund by being an LP, or you can come in as a GP and bring the fund as an LP. That's the way Ashton did it. So I guess that'd be a good transition point. Like, how are you set the structures of these deals? Or I guess let's just back up. Like on that first one, how did you bring capital, and have you done it up to this point?
Well, that was raising it from, from family and friends and from other individuals. There was a combination of 506B, candidates and 506C. So the first deal was a 506B offering. So, from the GP side. So
meaning that the 506B, you can bring accredited or non-accredited investors, but you're limited to the number of non-accredited investors.
Correct. And I had to have a private relationship with them, which I did, family and friends.
Yep.
So that's what we did. And then,
that gets into a whole bunch of SEC regulations. We'll skim over for now, but
but you definitely have to follow them. Yep. And I can see why.
It's just like when raising capital, the SEC wants to, basically protect the unaccredited, the less sophisticated investor, and make sure that, I think all this came after like the stock market crash of like 29, all these regulations. So SEC exists to protect the common investor from those kind of investments, like everybody, the common person losing all their money. So,
Yep. Yeah, exactly. So that's what the goal is right now. So I'm working on it on this fund. It should be I'm hoping to get it up by the end of April.
That's cool to see that evolution. Like you start just raising money from family and friends and 506B offerings, and then maybe, build up your network, show some track record, do a 506C offering, which is only accredited investors, but it's unlimited and you can advertise in a 506C, which you can't in a 506B. So it just changes the way you're able to raise money. And there's that evolution. And now you get to the funds model, where you can structure your fund differently, where you can advertise it and just pool money together and sit for the deal. Whereas normally 506B, 506C, you raise for a specific deal, but in a fund, you can just raise money for like a deal criteria.
Correct.
When a deal meets that criteria. So that's cool to see kind of that evolution. It's gone quickly, right? 3 deals in the first year. And now it's setting up this fund and getting operational. next
Right.
month and starting to move that way. So that's really cool.
Yeah, it's been an interesting experience. The one thing I will say, and I'll tell people, you got to get a mentor and you got to listen and copy success. I think there was a gentleman, Corey Peterson. Hold on, I got the book right here.
Always got to do that too. Like,
Corey Peterson's book, which is Copy Success. Right. Yeah. And like I said, just listen to your mentors, listen to people that have been down that road.
No, that's good. Yeah.
Exactly what I'm doing.
People have done it before you, right? And nothing is like, this isn't rocket science. It's just real estate, right? It's just buying properties and raising money. I mean, there's intricacies to it for sure. Right. But I mean, you can even just focus on one thing like you're doing, just raise money. So I think that's really good. And I wanted to ask, like when you're putting together this fund or just even on your past deals, are you looking, when you're looking to place those funds, are you looking for the market? Are you looking for just the sponsor and, you trust them and wherever they're buying, you'll take money to, or what's your criteria to direct that fund?
Good question. To me, it's combination of the market and the sponsor. One of the things I've been doing is I invest in other people's deals. So another sponsor's deal. So I get a feel for what they're doing, how they interact, what do they look for in deals, and how do they interact with the investors? How do they keep the investors on board? I do that just so that I learn from them. I learn from them to see, if there's something I could, like I said, I could learn from them to apply it to my strategy. Yeah. So to answer your question is, definitely the market, because you know some of the markets, and then you look for my sponsor network. I look for guys that have successful track records. Have they been through the life cycle? Have they, what's their credibility? And then like I said, I meet them. I would rather meet them personally. Like I've met a bunch through Zoom already, and so, I think we have a good connection, but I really miss going to these conferences. Yeah. And I can't wait. It's going to
I've already signed up for a few. I think the first one I signed up for is in May. And then there's one later in the year in like August. So I'm looking forward to those, getting in person. No, it's October. It's later in the year, like October. So I'm looking forward to getting back in person with people for sure. Shake some hands finally. Hopefully the vaccine spread enough that we can shake hands and not do like the awkward fist bump or elbow from a distance. but yeah, that's good. So you're meeting these sponsors online, on Zoom, whatever, like all these networking opportunities is when you can connect with these people. Once you start to have that network of investors to be able to bring money towards deals. But then you're talking about the market too. I know risk analysis and the data and the analytics is big for you. So what are some of the trends that you're looking for in markets? And, you don't have to disclose every single location you're looking for to have people flood those markets. But like, what are just some like general things that you look for in your markets?
The answer to that is what the sponsors say and all the successful sponsors. I got Joe Fairless's book here, The Best Ever Apartment Syndication. And he talks about the markets. He talks about demographics, the economy, crime. So what you do is you create a spreadsheet. Everybody does this, and you come up with your criteria. And a lot of it has to be driven by the job market, job opportunities, diversity. Like I said, demographics. And it's true what they're saying. The generation, the millennials are going to be looking for houses, and the baby boom people that are retiring. Yeah, I don't think they want to own a house. I think my feeling is that they want to find an apartment. So that's what's driving a lot of the demand. Plus, of course, the U.S. is growing every year. My understanding is that there's a shortage of new development.
Mm-hmm.
Yeah, so as a population,
everything I've heard and all the data I've read is just there's not enough housing units for people, and there's not enough to meet the demand. So, building new multifamily, even multifamily units are going to have that demand because there's not enough housing for everybody. And then you have like the baby boomer population, like you're saying, that's retiring. I don't even know what it is. It's like 7,000 a day, or maybe it's 700 a day. I don't know, but it's a lot. They're retiring quickly at a rapid pace. So it's like, where are all these people going to go? They're going to, downsize and not mow their own yards anymore. They're going to move into these condominiums or whatever, where that stuff's taken care of. So,
Exactly.
and Grant Cardone talks about this a lot. Like people just aren't buying houses. Like my generation, the ones that are a little bit older than me, mid 20s, early 30s, grew up in like this era when they saw their parents come through the housing crisis, or maybe they're about to buy their first home during that period or shortly after. So they don't, buying a house wasn't a thing for them because of the financial crisis in like 08, 09, 2010. So they still have that, that scar on. They're like, oh man, I'm not going to buy a house. I can just rent and not have to worry about getting foreclosed on and all this kind of stuff. So like you have a whole generation of people that are now more likely to rent, where all their parents, it was like the American dream was to buy. Now it's like, let's just be minimal. Let's be able to travel. Let's be fluid, all this different kind of stuff. So a lot of interesting things. The
book, Rich Dad, Poor Dad, where they talk about, owning a house, it's a big liability. And like you said, we were taught, about money. We really weren't taught about money, but we were taught about the American dream, owning a home.
Yeah.
But there was a lot of assumptions.
It's absolutely a lie. Like what you get taught in school from an early age is not always the case. Like the normal person's house is liability, because he talks about in that book, like whatever takes money out of your pocket every month is a liability, and something that puts money into your pocket every month or your bank account or whatever is an asset. And I think that's where, like, if you want to buy a house, a really good place to start is by house hacking, because then you have an asset that's producing income or cash flow in some cases. It's like all my houses, I look at them as assets for sure, because they have equity in them. I've fixed them up, and then they have the extra units. I've only lived in house hacks so far. So that's a great way to shift that thinking on its head and make your house become an asset.
Exactly. I wish I had learned this years ago. I really do. I always tell that, and I tell that to my nephews, and I tell them, I said, gentlemen, I said, you gotta think outside what you've been taught.
Yep. And the good thing is it's never too late. You start buying properties and build them up. And another way to think about it, it's like each of those properties its own like little retirement account, right? If you get good debt on it and it cash flows, you can hold it through, any market. That thing is going to produce cash and go up in value over time. So like, I think of all my properties like little retirement accounts, which I think is another good way to, think about real estate, because they're assets that go up over time. But John, what I wanted to talk to you about is like you're on Wall Street and your experiences in that whole environment. I think of like, Wolf of Wall Street, or even like Glenn Ross to an extent of like that atmosphere. But you work at a full-time job and still are able to invest in multifamily. So, I mean, for you personally, what does that comparison look like between investing in stocks and investing in real estate, and specifically multifamily? Because I haven't had a person that have been able to contrast this well. I think this would be a good topic to dive into.
Let's think of it. Let's go back. Let's think of it like a wealth management, right? Not money management, but wealth management. So let's say you have this portfolio of stock, bonds, and you've been taught, you want to diversify. What I think, from what I've learned, I think that'd be really valuable. I know they say to invest in REITs also, but I think, and this is where, for the little investor, it becomes tough, but I think you should take 10 to 20% of your portfolio and invest it into one of these multifamily syndication deals. Find the solid ones, because you'll get cash flow from it. It'll go into your retirement account. You can do that if you're an accredited investor. If you're not accredited, then you would have to find, and I had to do a little bit more research on it. If you can do a 506B into your IRA, you can actually, like, regardless of if you're accredited or non-accredited, you can invest in syndications through your Roth IRA or solo 401k, whatever that retirement account is, by rolling it over to self-directed. And then from there, it goes into the investment, into the property, and you get paid that cash flow back into your retirement account. So it grows, tax advantage of that retirement account, which is really, really cool. And I wish more people knew about that. I'm glad you brought that up, because that's a huge point. Like, so many people are sitting on, this illiquid wealth that they can access to their 59 and a half, and don't know that they can apply that to real estate to, get cash flow. And especially in value add deals like you're doing, John, is when you're creating equity in these deals, the payoff to the investor goes through that retirement account and grows tax
tax deferred, which is awesome.
But even then, even you could invest, because now, they have these Class A share, Class B shares, where Class A investors, they give them like a 10% pref, but no upside when they sell. Mm-hmm. But even 10% cash flow is pretty good today compared to, what bonds are giving you in terms of income.
Yeah.
So just think of it today, because bonds are very, very, the price, they're low today. The market is definitely riskier. You're going to have your ups and downs. It's just the nature of the beast. I mean, look how many ups and downs we have since 9/11.
So when you say that, do you mean the stock market's riskier, or like the real estate market is riskier?
No, the stock market.
Okay. I just wanted to clarify.
No, because in terms of multifamily syndications, because of the nature of the investment, when you invest in so many units, and when you have a lower average, unit cost, and you compare it to the market rents, mm-hmm. You can, to me, my sense is it's less risky than if you had you were investing in single family homes, for example. I mean, you wanted to rent those out, because now if you lose a renter, now you lose your cash flow mm-hmm. in a single family home.
Yeah. To get that, like, economies of scale, you really need like a full portfolio of single family houses, which, as you know, after doing it yourself, takes a long time and is a lot of juice or a lot of squeeze for a little bit of juice. That takes so much longer when you can bundle that in to one multifamily property and get that built-in efficiency right away. It's like one of the reasons I love it, because I just like you, I started out with single family. I was like, man, this is going to take, I'm doing a couple of these a year. It's still going to take
a lot of time.
So it's like, you got to find a way to boost up your acquisitions or something, and then it's a whole different process. So many closings.
And then you hire a property manager that has to go visit all those single family.
Yeah.
Like I said, the scale, that's why multifamily is the nature of it is makes it less risky in my mind.
Yeah. So for you, you like to look at it as like, yes, you should have money in the stock market. It's a good way to build wealth, have your retirement account, stuff like that, but allocate a portion of your portfolio to real estate, and specifically multifamily, because of all the advantages you're just saying, like the economies of scale. It's less risky because there's more doors at cash flows, and does well in downturns when you're going to have a more steady increase, whereas the market's going to bounce around a lot. So it's going to kind of hedge your risk in your overall portfolio. So I think those are all good points for sure. And one thing I wanted to ask too is, like, when you're getting or, having these conversations with investors, what is your whole, I want to say pitch, but it's not really a pitch. Like, what is your whole, presentation to an investor when they're talking about, I got money in the stock market, I got money in my retirement account, I can't invest in real estate. And then you have these conversations like, hey, there's, did you? What does that usually look like for you between you and your average investor? Because I think a lot of people are kind of hung up at this spot. Like, how do I go have these conversations?
Well, the way I look at it is it's further diversification. So one is capital markets, and then there's other entities you can quote invest in. One is definitely real estate. These multifamily syndications, commercial real estate, industrials and storage did really well during COVID. So it's a way of further diversifying your portfolio instead of just capital markets. And in terms of IRAs, there's moving money from your IRA into these types of investments. There are mechanisms out there, and you need to educate them. You really need to educate them. How do they do it? How you should do it, and show them the impact to their retirement. How, the pros and cons, and really the pros is you see what the impact is on their retirement savings. It's going to be it'll be substantial.
Yeah.
And the one thing about it is that, God forbid that you just before you retire, like all the people, the baby boomers that are retiring now, they got hit with COVID. So when the market dropped 40%, remember back in April, May, when it dropped, they must have been like, they must have been horrified to look at their. Yeah.
It's a great time to buy, but if you held right before that, you're thinking, holy. Exactly. And place your exclamation there. That's probably what you're thinking.
Exactly. So that's, so I've done it with my IRA. I've diversified, into several properties, multifamily syndications, and I'm looking forward to it.
Yeah.
Again,
that's good.
one thing you got to remember and tell the viewers that you really got to vet the sponsors. You got to make sure these deals are solid. You got to make sure that, and you have to do your due diligence. And that's part of my job, is educating them to make sure that, how do you vet out a sponsor? How do you vet out a deal?
Yeah, that's a really good point. And for you right now, what has been like your biggest way or your biggest avenue to bring on or reach new investors to bring them to your deals?
It's really been this, the diversification from the stock market is really, it's another avenue. If, like I said, if you find the right deals.
Yeah. I mean, for you personally, maybe I didn't clarify enough. Like, how are you like finding investors and bringing them in, like having those conversations, creating the relationships?
Well, networking is really networking. Going to, for example, here in New York, we have the Real Estate Investors Association. So I go there.
Mm-hmm. That's probably all online right now.
Yes.
Yeah.
Yes. Yes.
It sounded like a really official sounding, like,
it's unfortunate.
Red carpet, but now it's on Zoom.
Yeah, exactly. So, so you go to there, and then, you try to seek out, impact players, individuals that could run a family practice, like a lot of physicians, lawyers, accountants, people that would be high net worth, like you said, financial services consultants in financial services. I remember in Hunter Thompson's book, he mentioned there's 12 million accredited investors in the U.S. That number stuck out in my head. Yeah. Because all you had to do is a little simple math, and he does it also. And you say, you know what, you pick 200 investors, 50,000 a year, and right there's what?
Yep.
10 million. 10 million can get you $50 million deals.
Yeah. Yeah. When you break it down like that, if you just think about it, all right, I'm targeting, just like you were saying, I'm targeting a $10 million deal. How much do I need to raise for that? Say, 20%, 25% for the down payment, another 5 to 10 for repairs, closing costs, or whatever. So you're talking 35% for a total raise. In most cases, if it's a value add deal. So you're talking what, 3.5 million? How many investors at 50,000 does that take? And then you think about, okay, this is not that many people, right? You have probably enough people in your network right now, or that you're friends with on Facebook or LinkedIn or whatever, that you could reach out to and start having those conversations.
Exactly.
So that's really good. Just by like building out, thinking about your network, getting online, networking. Don't go in person to New York so you don't get like the 11th strain of COVID already. Does it look like I Am Legend right now? That's what I pictured New York City looking like, is Will Smith and his dog walking down the Broadway, and it's just empty.
It's kind of sad because I've taken the subway. I go meet a couple of people. The one thing that sticks out is the subways are empty. I remember I used to grab the train at 6 a.m. so I can get a seat going from Queens into South. The financial.
Now you got leg room and you can stretch out. But you know what? I think all the people that were on the subways in New York came down to the beaches in Florida, because our beaches have just been packed, and it's been crazy. I think I'm still attesting that the sunshine kills COVID. So all you New Yorkers, come down here and invest in Florida. We'll find you some good deals. They are.
I can tell you they are.
They're
definitely investing in Florida. I mean, I was asked to look at it. There was a deal in Orlando just recently. So there's tremendous opportunity.
That's awesome. Yeah.
So that's why my goal is to build. If I can get this fund up and running quickly, follow my mentors. Hunter Thompson, follow his his advice. And he focuses on building systems of systems to do this.
Yeah, he's really good. I've taken some notes from him, and I've read his book. It's here on my shelf somewhere, but really good stuff there. But John, before we get into the last section of the show, you've got these 300 plus units now, had a lot of success. I know we talked about the fund, but what's the future have in store for you down the road?
It really is to network, look at opportunities across the country. My goal is to eventually leave my full-time job, right? And then have it supplemented with the cash flows coming from these investments and the fund. And then build out the fund, I would like definitely to get into philanthropy also. And the other thing is I do is I look at this, when I look at these value adds and even Class B, I think it's a wonderful opportunity to help people out, especially improve their living, their living conditions, have them a place that they rent, that, that they're proud of, that they like, and they feel safe. You know, so it's a good product. It's a win-win for both investor and the and the tenants.
Yeah, and I think in real estate and multifamily specifically, I mean, really any class of real estate, but I mean, there really is a way to grow and be a capitalist and whatever, make a lot of money, but also do so in beneficial to society in a way that you can be beneficial to society. So I think that's really cool. You can provide great products to your tenants, clean, safe, affordable, housing, and still create massive value for yourself, your investors, your family. So I love that. I love how that's a focus, because I try to do the same thing, always provide a good quality product, great customer service, with the tenants, and just make sure everybody is living good.
Well, let me give you an example. I saw this being in New York many years. So when I was studying at Columbia University, I worked at Grumman on the island. I would travel into New York City, at night. So I went to school at night. So I used to cross 125th Street back in 1993, in the early 90s. And I could tell you there was a war zone. Okay. I mean, you could see, buildings that really were deteriorating, and you saw people, that you knew they were living there. Fast forward, 25 years of, you had Giuliani, Bloomberg. But I think the biggest driver of really making Manhattan and the surrounding Long Island City and, New Jersey City was the investors, the incentives they gave investors to take these properties, right, and the value and add value to them. I mean, they turned them around. Now you go across 125th Street, I could tell which building was renovated. You could tell, and it was wonderful what they did.
And that's what I like about it, is like you can actually have an impact. You can, you can benefit communities and just raise up a whole area by doing it right, by adding value, by, being conscious of the impact you're having in those communities. So I think that's really cool. And places like New York, I'm sure you could see it over the decades. So that's really awesome.
I just hope they don't return, because now they've taken away those incentives, what I'm saying?
New York needs some help. Hopefully it's better than Will Smith's ending in I Am Legend, to go back to that. John, let's get into the last section of the show here. Let's transition to the
Fortune 5.
John, these are the questions I ask every investor at the end of the show. So let's just get into it. Number one, what is the biggest thing that has contributed to your success?
Mentorship and teamwork.
That's huge. Yeah, that's paid off a ton for me as well. Huge, guys. If you have not thought about getting a mentor yet, or how you can grow faster, go look into how to find a mentor. But first of all, know what you want to do before you just don't say, "Hey, will you be my mentor, please?" Put some thought behind it, try to add value. But that's a great way. All right, question 2: what has been your biggest mistake so far that's turned into a learning lesson for you?
To me, it's time management. I need to improve my time management, especially if I'm going to take
you and me in 99%.
Yeah, exactly.
Out there.
And it's a learning curve, because I'm working full time. I mean, I'm putting in 100-hour weeks. Yeah. So, I work full time, but then I work the weekends. I just keep, because you have to work, being a GP is you have to, being in.
And that's all the behind the scenes stuff, the build up that nobody appreciates, but it's what creates everything down the road. So I actually had my first weekend this past weekend of not doing any work. Really, I did a little bit, but really not working. Me and my wife went to the beach and went kayaking and just chilled and just had us weekend. So that was really nice. But I'm right there with you. That's time management is a huge factor.
Sometimes I feel like I bit off too much, but then I say no, because I remember Cardone talking, you need massive action. You just can't sit back and do nothing, So that's what I've done.
Yeah. I think you sound like me a little bit, just too stubborn to quit and too stubborn to not get everything done that you need to get done. You just feel like it's like a competition against yourself. All right, I can beat this.
Exactly.
There you go. John, what's your favorite book that you'd recommend to someone starting out?
I would say The Rich Dad Poor Dad.
So good. Yep. Yeah, if you have not read Rich Dad Poor Dad, please do yourself a favor and go read that book. So instrumental. That's the one that really turned it on for me, right? Flipped that switch. I was oh shoot, I could just start buying real estate. I don't need to go make, the next Facebook or, Amazon, whatever. There's, like you were saying earlier, it's repeatable, right? You can model people's success. So
yes.
Good. Hey, you mentioned that other book you're saying, Copy Success.
Yeah, copies of this.
That's the name of it. Okay, cool. I'm going to put that.
Yes, it's called. All right. Yeah, it's called Copy Your Way to Success.
Copy your way. I'm going to go read that one because that's real estate in a nutshell right there. There you go. So John, outside of, closing deals, working 100-hour weeks, making that Wall Street dough, what do you like to do outside of real estate? There you go. Have you been able to do any during COVID?
Well, yeah, I actually went to Hawaii.
Nice.
Which was an interesting experience. And, and then again, to go into Virginia, Cape Cod, and we went to, I went to Savannah, Georgia. So nice. we did, and I can't wait till they open up Europe. I miss Europe. I went to Switzerland before. I loved it. Yeah. I have family in Spain. Oh, so I just love Europe.
So you got some good trips ahead of you then. So you're waiting for the vaccines to come out so you can get on the road, get on the plane, get on the boat, however you can get there. That's
exactly. Awesome. And hope everything's open, and that's it. We're back to being human beings again.
I know. I'm ready for you. I am right there with you. I think everybody listening to this is right there with you. Let's get back to normal. So wrapping it up here, John, where can people find out more about you and connect with you?
I would say right now I have a website. It's www.OneWayHoldingsLLC.com. And I'm going to be revamping that site soon once I have my fund up and running. So, but right now that's the easiest way you can get you could contact me there. And then the email I have is info@OneWayHoldingsLLC.com. Or if you want my private email, I have no problems giving it. It's jpania@yahoo.com.
There you go.
So that's
awesome. Yeah, definitely hit John up. Go check out the website. And John, thanks for coming on the show. Appreciate you coming on here and providing value. And here's to New York opening back up so you can get out a little bit.
Thank you so much for having me on. It's been a pleasure.
Absolutely.
Really pleasure.
Thanks, John. All right. And we're out of here. Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. And if you want to check out more on your multifamily journey, go to multifamilyjourney.com where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.